Good morning. It's Friday, the 7th of March, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital. The take. For all the breathless reporting on Tesla's imminent entry, which is expected to send Musk fans into raptures and global auto giants begging for mercy, the total investment from Tesla at this point is 35 lakh rupees a month. At Delhi, and maybe it'll be 70 lakh rupees a month, and that's, of course, rent. Because that's the cost of renting two showrooms of about 4,000 square feet each. That being the size of the Mumbai showroom, which we know, it's unlikely Delhi will spring any major surprises. Even two-wheeler showrooms are bigger in many cases, and most car dealerships are 5,000 square feet and upwards, including in big cities. A 4,000 square feet showroom is not unusual. There could be even smaller ones, but this is not the giant killer that Tesla is being made out to be. Not just that, it's surprisingly low-intent, test-the-waters entry strategies, only revealing that Tesla can be a great engineering product, but is not a company that wants to get its hands or feet dirty as other auto giants have done in their experiments with India. Not surprisingly, people are speaking up. JSW Group Chairman Sajjan Jindal said on Thursday that Tesla's entry into India's electric vehicle market will not be easy, as the company is set to face stiff competition from domestic players like Tata Motors and Mahindra. Speaking at a Ernst & Young Entrepreneur of the Year award, he said that Elon Musk is not here. He is in the US. He can't be successful in India. We Indians are here. He cannot produce what Mahindra can do and what Tata can do, presumably to much applause. Jindal did acknowledge Musk's genius. He's super smart, no question about it. He's a maverick doing spacecraft and all of that. He's done amazing work and I don't want to take anything away from him. But to be successful in India is not an easy job. Jindal only sums up what every business, domestic or international in India, knows fully well and has done so for years. You can build cool electric cars and reusable rockets, but it takes that and much more to succeed in India. Or you get the President of the United States to bat for you. Because even that may not be enough, because a close to zero import duty demand, going by reports, is tough to offer. The Indian consumer can be idiosyncratic across product categories. In cars and two-wheelers, again, customers want to be sure, for example, that there is after-sales service and a visible one, and that the product in question does well on Indian roads. For example, it may not help that some of Tesla's models' ground clearance might be a little low for Indian roads. Now, that, of course, can be engineered, and then adding a loud horn, which also is an imperative for Indian vehicles and roads. But all of that means more customization and thus cost. So it will take more than just picking vehicles off an assembly line in Berlin or wherever and putting it on a ship bound for Mumbai port. Multinationals who've invested in India in the long term have spent time and effort in understanding the market and then succeeded. But they've failed too. Like Ford and General Motors have come and gone, though Ford is now returning. But other car manufacturers who've had the patience have done well, though within their own cycles, like the Europeans, Japanese and Koreans. Perhaps Musk's genius has allowed him to see what others have taken longer to understand. India is a great consumer market, but only for the patient. And that brings us to the top stories and themes. The markets continue their upward rise on lower oil prices. The Reserve Bank of India could tighten norms for lending against gold in sign of an overheated market. Why is the stock market turning at this point, and what might lie beneath the numbers? Auto sales are falling as customers postpone decisions and financiers tighten their purses.
This is a call report with Govindraj Ethiraj.
Markets stay up. It was interesting to see the bulls dominate, keeping the indices up despite the selling that kicked in after an early and positive start on Thursday. The markets appear to be primarily driven by factors like lower oil prices and in some sectors like air conditioners and energy riding on projections of higher temperatures and a hotter summer. Low oil prices means the economy benefits broadly because we import almost 80% of our requirements, and also a lot of oil-linked companies benefit, which could include the refining companies and companies who use intermediates like paint companies. The Sensex and Nifty were up for the second consecutive session, and the 30-share Sensex closed up 609 points at 74,340. The NSE Nifty 50 was up 207 points to 22,544. The Nifty 50 is down at this point about 14.2% from its record high hit in late September. The broader markets did well too, with small cap shares staying ahead, with the Nifty Small Cap 100 index going up about 1.3%. The Nifty Mid Cap 100 index was up slightly less at about 0.4%. Makers of air conditioners and cool beverages and power companies saw an uptick in their stock prices on March 6th as investors expect stronger sales in the upcoming summer season, according to Money Control. Now, while tariff fears are keeping world markets on an edge, the flip flop is also evidently tiring traders out. For example, the US has imposed tariffs on Mexico and Canada at 25%, but is carving out or away energy and then cars and then now apparently agriculture. Despite all these trade tensions, Asian currencies have remained relatively resilient in light of a broader dollar decline and worries that US growth is slowing, according to Reuters. Meanwhile, on Wall Street, stock futures were under pressure on Thursday as investors sought out more clarity on the latest US tariff measures, CNBC reported, adding that futures tied to the Dow Jones Industrial Average fell about 378 points. S&P futures and Nasdaq were all down more than 1% each. So how do we view the current uptrend in the market, that's the domestic market, from a fundamental or technical perspective? I reached out to Chokkalingam, veteran market analyst and founder of Equinomics Research, and I began by asking him what had changed, even if for only 2 sessions.
Definitely, oil plays a crucial role because if you look back 2016, when the global deflationary conditions emerged, again COVID time, oil price crashed unbelievably. And that alone, I could say that gave a very predominant relief to the Indian economy and therefore largely contributed to the market recovery. As of yesterday closing, the oil price is down 27% from 52-week high. We roughly put about 140, $143 billion worth of oil. So just imagine 25% fall can save you around 30 to $33 billion, which is more than our Indian pharmaceutical industry exports. So the kind of impact it will have on foreign exchange reserves, rupee exchange rate, inflation, and also the corporate earning, particularly the segment which uses oil or oil derivatives as input. So it plays a major role. That is one of the reasons this time. And apart from that, the Q3 GDP also gave a little confidence. Of course, number came a little early, but then market was terrified by Mr. Trump's statements on or his moves on tariff war. But again, I believe market unnecessarily feared it too much, I believe, because India trade surplus with the US is around $40 billion, which is nowhere comparable to $361 billion of trade surplus China generated in 2024 calendar year. US can, affect India because this doesn't include this IT exports. I am talking about the goods exports. If US makes any adverse move, then yes, we will have problem. But then there is theoretically or logically, there is no fear on that because the tariffs are more or less similar. You take a GST or you take income tax in both countries in treating IT services. So therefore, I believe market is slowly getting some confidence on that. That is a third. Fourth, as I've been discussing with you repeatedly, despite such a crash, the investor inflow is continuing. Even last week, over 5.5 lakh new investors have entered. So 5 to 8 lakh new investors are still coming into the market. Prior to that, 2 weeks prior to that, it was even 8 lakh per week, 7 to 8 lakh. So obviously, when new investors come, they would come with fresh resources to invest. The fifth reason, as of day for yesterday closing, we lost about 102 lakh crore of market cap from 484 lakh crore peak level in September 2024. The equity wealth evaporated to the extent of 102 lakh crore, which was which was more than the entire market cap in 2014 May. That time the entire market cap was 84 lakh crore only. Now, such a huge fall, which was almost 31% of India's nominal GDP for FY25. So very rare. But of course, just because it has fallen, that doesn't become an argument for buying a stock. But then what happened? On the one hand, when, perception-driven stock, which do not have a justification for valuation comfort, and they fell very badly, the quality stocks also fallen very badly. Post to this, 31% of GDP level in the market getting wiped out, made many smaller pockets of small and mid-cap segment very, very attractive. I could see the pulse of investors in my limited circle. So they all got attracted. So these are the, 4-5 reasons for market recovery. And also, as you go close to March, a lot of people have a tendency to book losses and reduce, overall tax liability at the back end of the year, particularly when the first half was too good and second half was too bad. That also should taper off because now we are already into advanced tax payments. So Therefore, I believe day for yesterday, probably the market has bottomed out. Yes, there can be volatility. 1 or 2 days we may fall, but I think the underlying trend has bottomed out and it is for a recovery. I am not saying it is set for a massive rally, but definitely looks like we are set for a sustained recovery from the middle of this month onwards.
So, which means you're saying that foreign portfolio investor selling also should slow down or is slowing down already? Because that is what is triggering most of it, isn't it?
That we cannot derive automatically. That is a relative call. And they may wait for April first week for Mr. Trump to, clearly state what he intends to do in terms of tax policies towards India. But, the small and mid cap stocks are the main domain of the retail investors. That is where still a lot of growth opportunities, value unlocking opportunities are available. But to be fair, in the Nifty Sensex, majority of the sector, what I call as a single digit growth syndrome, still exists. Unfortunately, even Q4, you may not see strong double-digit growth in sectors like cement, automobile, FMCG volume, IT service exports in dollar term. So there are so many sectors where you may have a single-digit growth syndrome. So it is too early to expect the FIs to turn buyer. It might take a month or it might take even a quarter. That is why I believe small and mid-cap segment should outperform the large caps in the very near term.
If I can ask you an interest rate question, so the CRISIL Ratings has just put out an outlook saying that they're expecting 50 to 75 basis point reduction in 25-26. The European Central Bank has on Thursday cut rates by another quarter percentage point. So it's now, rates are down further in the Eurozone. Now, all of this could, if there is a clear now move towards lower interest rates, do you feel that transmitting to better corporate performance, better balance sheets, and so on in this round?
Yes, definitely yes. As we discuss about oil price, that plays a crucial role in bringing down the interest rate also. Mr. Trump would contribute to worldwide interest rate cut because he would cause little global pain and that would translate into further crash in the oil price. Today, few days back, there was a report that small businesses in the US, which account for half of employments, they are feeling the pain of the trade war. They are say that their margins have come down and profitability is hit. And today, there is a news that the employment job cuts to be a record level since 2020 COVID time in the US. That would mean deflationary conditions spreading, first forming in a significant way in US and then spreading across Europe as well. And therefore, the oil price should fall further down. Last week, Saudi Arabia and Russia announced a further increase in the oil output. And then Mr. Trump also for increasing the or maximizing the oil output in the US. All this would mean further significant fall in the oil prices. And secondly, the monsoon forecast, the South Korean agency says there could be normal monsoon for India. So if IMD also forecast, and with the record level of crop output expected in the current crop year, I think CRISIL statement could be understatement. I would say that confidently, if monsoon doesn't fail in a big way, I think the rate cut would be beyond the 50 basis point. And that would lift the market once again significantly.
Chokka, thank you so much for joining me. Crude oil prices stay soft. In all the trade wars so far, the best news, of course, has been that crude oil and crude oil prices are staying low. Prices are staying soft now below $70 a barrel on signals from the Organization of Petroleum Exporting Countries Plus that they will ramp up production. Brent crude had fallen to as low as $68.30 on Wednesday, which is its weakest since December 2021. Analysts had been predicting right through, including on the core report, that the prospect of more oil flowing from the United States post-Trump would lead to lower prices, and now OPEC countries or OPEC Plus countries are also saying that they're increasing supplies. The OPEC Plus producer group, which includes the OPEC countries and allies including Russia, decided on Monday to increase output for the first time since 2022. Meanwhile, Reuters is reporting that US exports of crude oil to India last month climbed to its highest in over 2 years, ship tracking data showed, as refiners in India sought alternative supplies following tighter US sanctions on Russian producers and tankers. The US exported about 357,000 barrels a day of crude to India, which is the world's third largest oil importer and consumer in February, Reuters said, quoting ship tracking data from Kepler. Last year, exports from the US stood at about 221,000 barrels per day. Gold loans could get tighter. The Reserve Bank of India may ask lenders to follow stricter underwriting processes for gold loans and monitor the end use of funds, according to Reuters. The Reserve Bank of India wants banks and non-banks to also increase background checks on borrowers and ascertain the ownership of the gold that's being mortgaged, according to sources who spoke to Reuters. Since September 2024, bank gold loans have been rising by 50%, sharply outpacing the growth in overall loans, thanks also to tighter norms for unsecured lending. Interestingly, September 2024 is also the point at which the stock markets have turned and falling since then. India is the world's second biggest consumer of gold, and prices are, of course, near record highs. The Reserve Bank last year had hauled up several non-bank finance companies for lapses in their practices, including the way they were appraising and valuing the gold that was being deposited with them for the loans that they were giving out. Auto sales are down. Customers are coming to dealerships but not converting or buying like before. Vehicle prices in relation to aspirations and incomes are rising, and financing has become tougher. Also because the Reserve Bank of India had raised risk weightages, which it has now loosened once again. The net result is slowing demand, with February seeing passenger vehicle sales drop almost 10% year on year. Even two-wheelers, which had been doing well last year, has dropped about 7%. All of this is for February 2024. The Federation of Automotive Dealership Associations, FADA, has said that even in the two-wheeler segment, despite a close to 8.6% year-to-date growth, retail sales have fallen by about 6.3% year-on-year. Urban areas saw a sharper decline at about 7.4% compared to a 5.5% drop in rural markets. So urban markets are doing better, but only comparatively, but both are dropping. FADA says inventory levels at around 52 days or so, though down from a record peak of about 80 days last year, is still high, and more on that shortly. I reached out to CS Vigneshwar, president of FADA, and I began by asking him why sales were dropping in this manner in the month of February.
Right, there's been a bunch of things happening. To start off with, there have been headwinds, which has been there for the last year at least in the industry. Quite a few reasons. Last month, there have been a bunch of reasons. I mean, when you look at it in general, there's been a lot of stock which is being, again, accumulated at dealerships. So therefore, we are, to start out with, overstock. We're also looking at the markets. Last 5 months, I think there have been issues at the market, and we feel that customers are probably putting the money in the stock market and they don't want to withdraw it right now at its low, and they probably wanted to recover and do that. So the discretionary spending again has become a bit of a question. That's one. Also looking at it from the point of view that the general thing regarding, probably when he spoke yesterday, the whole concept of tariffs sort of come up, and tariffs again go on to affect a large portion of the industry. So that probably also weighing down on people's minds. We are also looking at a lot of NBFCs tightening their pockets in terms of giving loans. Delinquencies also have crept up according to them. So therefore, all these factors also making NBFCs a little bit more circumspect in terms of lending. That's also there. We are also finding that at some places we are, let's say, even the PV industry, customers are taking a longer time to make a decision between inquiry to booking. This also is the conversion rates are taking longer. More customers are coming in. The walk-ins are quite decent. Inquiries are quite decent, but customers are trying to find better ways to spend their money on vehicles themselves. So they're trying to shop for better interest rates, try to shop for better deals in finance. But as I told you before, financing is becoming a little bit difficult. So all these factors have probably played into the numbers in February.
Both passenger vehicles and two-wheelers have fallen. That's usually not the case because two-wheelers, at least in recent years, has maintained a somewhat steady trend. So why has that happened?
And the last year has been great for two-wheelers compared to 2 years previous that. We are seeing that a lot of headwinds also be there in the two-wheelers segments. As I quoted before, the NBFC challenge and the banking challenge also exists there. We also seen there's a fall in sales, both in rural and urban, but the rural sales have been a little bit more healthier. The fall has been lesser. So, which means that decent agriculture produce and the agriculture economy is relatively doing better than urban. And even when you look at urban customers, the prices of vehicles are fast outpacing their salary increases. So this might be to environmental reasons, for technological reasons, for whatever it is. But it hasn't been an even growth. It has been an extraordinarily fast growth in terms of costs of vehicles. And also aspiring customers want larger engine two-wheelers. These things have actually been a bit of a damp.
You said that when people come to dealerships, which means they've already decided that they want to buy a car, I mean, sticking to cars, and yet they are not converting, which was, I'm assuming, not the case earlier. So, what exactly is causing them to pause at that point?
The market situation, as I told you, the discretionary spendings have become a little bit more difficult for them to make a decision on. And today, the quality of cars also have gone up. So even the second-hand market has become a good option for them to choose a car from instead of a brand new car. So a lot of companies are very good used car programs where they're also refreshing the used cars. So that's also become kind of a competition within a industry. But most dealerships have a used car wing. So there again, customers are not totally going away as such, but there's another option for the customer.
Right. Now, within models, are you seeing any trends? For example, we saw the massive response for Mahindra's electric cars, the launch, which is going to come into the market soon. So that was quite substantial. So are there any other such trends that you're seeing?
Question of not only EVs, it's actually a question of alternate fuels. So we not only had EVs playing into it, we have CNG, which has been doing reasonably well all these years along. We also have hybrids, which have really taken off. The future would be probably hydrogen fuel cell vehicles, which also are in people's consideration, but I mean, it's not there as yet. But definitely hybrids, EVs, and CNGs also play a very important role to augment the existing petrol and diesel technologies. So I think we'll have a host of things happening. We really don't want to, from FADA, say one particular horse would do well, because I would really think this horses for courses. And we are quite agnostic regarding which one is going to really succeed in the future. But all these technologies are competing for space. And all of them have a key point.
Right. You said in your formal release that inventory levels are still a concern. Now, it still seems to be lower than what it was compared to last year when you had peaked at almost 80 days and you're now seemingly at around 55 days.
So we were at crazy, unbelievable highs last year, which shouldn't have happened. And currently we are at about 50 days, which hasn't reduced at all from last month. The healthy inventory would be 21 days. Anything about 30 days doesn't start making sense because discounts start going up. For the margins we get, we also have other expenses like salaries, rentals, etc. The moment we cross 30 days, because of inventory, discounts also start going up. So I don't think it's free at all for anyone concerned. And OEMs have a large role to play and responsibility in helping us reduce these numbers. Quite a few OEMs have actually taken cognizance of this. Some of them have not. When certain large, I don't want to mention names here, but certain large volume manufacturers start dumping vehicles without the consent of dealers, I think that's not the right thing to do at all. It's great for stock market saying that we have sold so many vehicles, but the question is, whom do we sell it to? Dumping it on dealers doesn't mean it's sales. So here again, it is very important that everyone start talking about retails rather than talking about wholesales. And the wholesales are great for stock markets. Even for the stock market, it's not great for the long run because the dealers, the network starts suffering and the customer starts losing in the long run.
Right. What's your outlook for the next few months?
March would be better than February, that's for sure. But the challenge is whether March would be better than the previous March. There are, of course, good tailwinds there, festive season in terms of Navaratri, Gudi Padwa, and Holi would help. Traditionally, March has been a depreciation month, so there would be companies and customers who would want to probably pick up vehicles because of the depreciation benefits. But that apart, there are enough headwinds for us to contend with, and we can't do it alone. We need to work with the OEMs and with the banking and finance sector to help customers to get their dream vehicles.
Vignesh, thank you so much for joining me.
Thanks so much.
And before we go, here's some feedback from our listeners. So firstly, thank you very much for tuning in and patiently writing your feedback, as Samanad has said with his very good morning, and also for your voice notes. And that goes out to Suresh Advani from Mumbai. Meanwhile, Kitu says that we need mature Indian sectors to be competitive at global scale, so taxation should be revised accordingly. This, I'm assuming, is a general reference to overall taxes both within the country as well as to import duties. Invidiology has given us a contribution. So thank you very much, Invidiology. And she or he says, thanks, Govind and team. I really appreciate the effort put into doing insightful financial reporting. This is becoming my daily go-to Indian financial news source. Invidiology, thank you so much for your contribution and your kind words. Both matter a lot from all of us here at the Core Report. And that's it from me for this week. See you next week. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.